listening to Her Profit Era, the podcast for founders who want a business that actually works. A business that's profitable, predictable, and pays them well. I am Cindy Kumar, a CPA, a fractional CFO from Abbotsford, BC, Canada. I'm the person founders call when they're tired of high revenue months with no money left over. I started this podcast because too many founders were chasing sales while their margins, cash flow, and bank accounts told a completely different story. I believe profit and money in the bank is a standard, not a bonus, and that every founder deserves clarity around their numbers. Each week, you'll get real financial strategy you can actually use and honest conversations with founders and industry experts about what it really takes to build a business that lasts. I've been watching Dragon's Den for 20 years now, and I've been in conversations with people behind the scenes. I just recorded a conversation with Molly, a producer of Dragon's Den. If you haven't listened to that episode, it came out before this one, so check that one out. And I've also been talking to founders who have pitched, who have gotten deals, who haven't gotten deals. And it's just so interesting to learn what the experience has been like. I also attended the 20th anniversary event in Calgary, and I nerd out about the numbers side. I love watching the pitches. I love hearing about new products and services. But the part that I love the most is hearing about the valuations, hearing about the numbers, hearing what the Dragon's Girl founder is on. And here's the biggest thing I've realized. Everyone wants the deal, but almost no one builds like they're going to be audited. The pitch part is exciting. You get to stand on stage in front of the dragons. You get to share about your product and services. You're on national TV. But the financial aspect, that's where founders are so unprepared. It's like they completely block that side out. Or you'll see them where they'll say this valuation, but they can't back up the numbers. Or the dragons will ask them something numbers related and they'll just freeze. They'll say they need to talk to their accountant about that, or they just can't remember the number. And understanding the number side and having that part ready for your pitch is just as important as sharing your product or service. So today I'm going to be talking about the number side, whether you're planning to pitch on Dragon's Den, you want to eventually exit your business, or you eventually want investors. Like, this episode is for you so you can fully understand what it actually takes to understand the number side of your business. So I want to start off with founder thinking and dragon thinking. Now, let's break the disconnect between the two. Founder thinking is they just need to believe in me and my product and service. Dragon thinking is show me the math. Founder thinking is the market is huge. Dragon thinking, how much profit are you making today? Founder thinking, we're growing really fast. Dragon thinking, at what cost? Founder thinking, we'll be worth 10 million. I'll be able to exit and sell this business. Dragon thinking, what's your EBITDA? Founders really sell the possibility and have wishful thinking of what their business is going to look like in the future. Dragons are really focused on what your business looks like in the present moment because they're investing in your business in the present moment. They're not investing in the future of your business because there's so much unknown. And really, I want to talk about stop leading with revenue. I feel like a lot of founders only focus on like the revenue number, but they don't understand profitability. They don't understand what's left over, what's in their bank account, how much runway do they have, what's their break even. Like, there's so much. There was actually a moment on Shark Tank where Mark Cuban stopped a founder mid-pitch and redirected the conversation to profit and cash flow. Now, that moment really mattered. And I was even yelling at the TV, like, yes, we need to talk more about what's left over because revenue means people are buying your product. Profit means you're actually keeping money. Cash flow means you actually have money available. You can sell $1 million and only keep $50,000. And if that $50,000 is tied up to inventory or you have unpaid invoices, you really don't have that money. Now, I work with founders doing 500K, a million, 2 million plus, and I always ask them, how much did you actually keep last month? And a lot of times they have no idea where we have to go back, open the QuickBooks, look at their bookkeeping if it's up to date. And it's not because they're not capable, it's because they've been trained to grow revenue and not protect margin. Now, investors care more about what stays in the business and how you're planning to fund growth and what it's going to look like. Now, let's talk about the numbers you need to know because everyone knows their revenue numbers, but everything else is completely blocked out. So, if you've ever wanted capital, you need to understand these numbers really clearly. So, number one is gross margin. So this is your revenue minus your cost of goods sold divided by your revenue. So if your margin is thin, scaling makes it worse. Now here's an example. I work with this spa owner. She has 2 locations and she makes 100K months. Well, her team cost was like 65 to 70%. So she's left with 30% gross margin and then just paying all her overhead. She has nothing left over to pay in cash. She has no money in her bank account, nothing to pay her taxes with, no emergency savings. So, this is why understanding your gross margin is really key. Now, let's talk about net profit. So, this is your revenue minus all of your expenses. So, it's really looking at like once you make all your money, you less everything you're paying for, and then you look at what's left over. So that's your net profit. Now, EBITDA, Michelle has even posted content around this as well. And it stands for earnings before interest, taxes, depreciation, and amortization. Now, in simple terms, it's how strong is the business before financing and accounting adjustments. Investors use EBITDA because it shows operational strength. Now, if someone asks your EBITDA and you hesitate, that's a red flag. You need to know this number, especially if you're pitching on Dragon's Den. Now, the next one is break even. So, understanding what it actually costs to run your business. So, how much do you need to sell before you make any money? So, let's say your costs are about $50,000. Well, and you sell your offers at like, let's say $10,000 for simplicity purposes. Well, then you need 5 clients to hit that $50,000 to cover your costs. Now, anything above that 5, that's where you become profitable. So understanding your break even is super key. A lot of clients are so surprised once we do the math and look at their break even per month because some months they're not even hitting their break even point. Now, the next one is cash flow. So cash flow is really looking at when does money come in, when does it go out, how much is left over. You also need to know how much money is in the bank. What's your monthly cash burn? How much debt do you have? What's your debt repayments? What about your inventory levels if you have a product-based business? Now, profit on paper does not equal cash in your account. Now, this is where most founders lose the deal is just on their valuation. They walk into the den, they come up with this big number, and the dragons are surprised, but they're looking for facts and proof that your valuation backs up what you're saying. Now, most founders don't lose the deal because their business is too small. They lose it because they overvalue. They value based on potential and what their business can do in the future, rather than focusing on what is it valued at right now in this present moment while the dragons are investing. So here's how valuation is actually built. I'll give you some different examples. So number one is profit multiple. So this is your net profit times the industry multiple. So let's say, for example, your net profit is $120,000. Well, your industry multiple, let's say it's 3x. So your valuation would be $360,000. You're really just taking the $120,000 and multiplying it by 3. That's it. Now, if the multiple is 4x, then it'd be $480,000. Now, the multiple depends on risk, stability, growth, industry norms. The higher the risk, the lower the multiple. Now, let's talk about the EBITDA multiple. Let's say your net profit is $150,000. Your interest is $10,000. Taxes is $40,000 and depreciation is $20,000. Well, your EBITDA is $220,000. If the industry multiple is 4x, your valuation is $880,000. Now, this is common in investor conversations. The next one is revenue multiple. This is mostly used in high growth sectors. So let's say your revenue is $1 million, your multiple is 1x, so your valuation would be $1 million. But revenue without margin lowers the leverage. So if you're barely profitable, investors won't apply a generous multiple. There's also an asset-based valuation, so it's really just your assets minus your liabilities. It's used when equipment, property, or inventory hold a significant value, and this isn't common for service-based businesses. There's also a discounted cash flow. This is more advanced. It's based on your project future cash flow. You discount it back to today based on risk. This is used in larger deals, but projections only hold weight if current numbers are stable. So most likely you won't be using this method. And here's the truth. If your business makes $150,000 in EBITDA and similar companies trade at 3 to 4x, you're likely in the $450,000 to $600,000 range, not the $5 million because the market is big, or on revenue that your business could or could not do. When founders argue valuation emotionally, investors really have to take a step back. Because if you can't separate ego from math, you're not ready for an investor or even capital. Now, if you really want investors, whether you're going on Dragon's Den, you're looking for investors outside of that, you really need structure. So let's say you're self-employed. You can't even sell shares because you have no equity to offer. So if you want investors or even going on Dragon's Den, like you need to have structure built in your business behind the scenes. So you need to incorporate, you need proper share structure. You need clear ownership. You need clean corporate records. You need separate bank accounts. Like your personal spending can't be going through your business. You actually need monthly bookkeeping up to date. You can't want equity while just operating like a casual kind of side hustle kind of business. Like you need to have the structure before you even ask for an investment. Now I want to talk about the due diligence process. So if you do end up with the deal with a dragon or maybe even a private investor, they want to look at your financial statements, your tax returns, your bank statements. They want to know how much debt you have, what kind of debt you have, your statements, share structure, inventory, cash flow. And here's the part. If you're going to be on national TV talking to dragons or even investors, and you say your EBITDA is $250,000, but once they review your books, it's only $140,000, you're going to lose credibility and trust. If you said margins are 60%, but numbers show 42%, like the trust is gone. The credibility is not there because you're overstating all your numbers. If your share structure is unclear, that's really a problem. And due diligence is just verifying what you said to the potential investor actually backs it up with the numbers. So you really need to make sure you understand the number side of your business. You can confidently say the numbers on stage or in like a pitch meeting and actually have like the backup for it. Last thing you want to do is like say all these big numbers and then your bookkeeper or your accountant comes back to you and gives you like the actual numbers and they're not even close. Now, if you're listening and feeling uncomfortable, good. It means that you care and you really want to pitch. You want to go to auditions, you want to do all of these things. I want you to slow down. You don't have to fix everything overnight. So start here. If you have an accountant, book a meeting. Ask them to explain your margins. Understand EBITDA and structure things clearly. If you have a bookkeeper, make sure your books are updated monthly. If you're mixing personal and business finances, like separate it immediately. If you don't understand cash flow, list your fixed monthly expenses and look at your actual revenue. Understand your break-even points. And if your legal structure, like you're still self-employed, you don't have a share structure, go find a lawyer. Talk about those things. Understand all of that. And here's where I come in. I work with founders all the time, whether it's for taxes, for advisory support. I really want to understand like how can I support this client in becoming more profitable? I help them build cash flow forecasts. We look at like EBITDA, margin improvements, valuation models, building up their emergency savings, share structures. I support them with finding like a good lawyer that can support them on that end, even exit planning. So, really, it comes down to understanding how important your numbers are to your business. And maybe you're just like, I'm not ready to pitch on Dragon's Den. I'm not looking for investors. Well, that's totally fine, but you still need to understand these numbers. You still need to understand and take responsibility over how your business is structured. Now, everyone wants the deal. Very few build like someone is reviewing their business tomorrow. So if you want capital growth and exit, you need to start thinking like an investor. So when you apply to Dragon's Den, maybe you're going for the auditions happening right now, you need to start thinking like a dragon. There's 20 seasons of episodes. Even Molly said this in our last episode. Just watch old pitches. It's like common questions. You'll see valuation is always a red flag. So focus on your valuation, understand your margins, understand cash flow, forecasting. Like you need to know all of those things. You can't just be super passionate about your product and service and just expect the dragons to only focus on that because they want to know how are they going to make money from your business? How are they going to get their initial investment back? Because they're not just donating money, it's real money, and they want to earn returns on them. And that's fair. If you were in their shoes, you would be expecting the exact same. And you wouldn't just hand your money openly to anybody and everybody that wants an investment. So everyone wants the deal, but very few build like someone is reviewing their business tomorrow. So if you want capital growth or an exit, you need to think like an investor, think like a dragon, think like a shark. You need to know your margins. You need to know your EBITDA. You need to know your cash flow. You need to structure your business properly. You need to value realistically based on what your business looks like now. You need to make sure your documents match your words and what you say. Because when opportunity comes, it won't wait for you to clean up your books. Now, you really need to take responsibility over your books, understanding your numbers, and just holistically understanding your business as a whole. Think 3 to 5 years down the road. Think from like an investor standpoint. Now, the more you start to do this, the easier it'll become. And if you need support with structuring your business, understanding your numbers, being pitch ready from the numbers side, I would love to support you. So I do have a link in the show notes to book a profit strategy call with me. That's like my one-on-one kind of partnership with the clients that I work with. So if you are interested in connecting or even learning more about how I could support you, that would be the best way to connect. You can also connect with me on Instagram at it's Cindy Kumar or at Elevated Accounting. Send me a DM. Let me know you came from this episode. You're planning to apply, you're planning to pitch, and I could give you some pointers. We can work together, like whatever it is. I'm all about supporting the people that I work with. So feel free to send me a DM, leave me a comment on the episode. If you're not ready for investment yet, but you have friends, family, someone you know that's getting pitch ready, feel free to share this episode with them. And I'll see you next time. If you're a founder who wants real strategy, not noise, and you want someone in your corner helping you build a business that feels aligned, is profitable, and actually supports your life, you can apply for CFO on Call. This is my one-on-one financial partnership for established founders, typically making between $500K to $2 million, who want clarity, who want structure and confidence with their numbers. The link is in the show notes, so you can schedule a profit strategy call, or you can DM me CFO on Instagram at it's Cindy Kumar, and I'll send over all the details.